This is Lucky Lecture 13, Long-Term Assets and Depreciation 1. Okay, so we've talked about long-term assets before, but only briefly. So we're just going to go through it in a little more detail over the next couple of lectures. So let's start at the very beginning. The first thing that you do with a long-term asset is you purchase it. So let's say I was purchasing a new computer system for my business. Now, I don't know much about this stuff, so I call up some company down in Southern California, and they, give me advice and they help me figure out what kind of hardware and software and peripherals and everything I'm going to need. All right, so we put all that together and I purchase the new computer system. So I have to pay the asset cost. Now, of course, because the other company is in California, I also have to pay sales taxes. Now, suppose they weren't in California, suppose they were in Asia, right? Then I wouldn't have to pay sales tax, but I might have to pay customs fees or duties or other amounts just to bring these items into the country. So usually there's some kind of taxes somewhere, whether it's your regular sales tax or import taxes or anything like that, but they also have to be paid. Now, this company is down in SoCal, so I'm going to have to pay for shipping to get it up to me, and also for some insurance on the shipping. All right, next, the items get to me. I have all the pieces of the computer system, and it's sitting in boxes on the floor. And the problem is, I don't know anything about this stuff. So I've got to call the Geek Squad, and they're going to come in and install my new computer system for me. And so now I have installation costs. Okay. Once I have set up the the computer system, and I've installed it, we're going to do some test runs just to make sure that it works. Okay. And then finally, I bring my employees in and I say, hey, here's your new computer system, go to it. And they look at me and they say, we don't know how to use this. All right, well, now I've got to bring in some outside people and train them. Okay. And I mean, I'm kind of going on with this example. There could be other things too. But these are some of the more obvious things that you might encounter as you are purchasing a new asset. Now, the question is, what is the cost of my computer system? What is included? And the answer is all of these things are included in the asset's cost. Okay. Now, why are they included in the assets cost, right? Even though they're actually not what we paid for it, right? I guess I should probably be more specific and say this is the purchase price, right? What's included in the, why are these things a part of the cost? Well, let's put it this way. If I didn't pay for these things, then I wouldn't be able to use the asset, and therefore it would not have value for me, right? If I didn't pay the purchase price, I'm obviously not getting the asset. If I don't pay for the taxes or the customs fees, I am not getting the asset and I can't use it. If I don't pay for the shipping, then I'm not receiving the asset and I can't use it. If I don't pay for installation, I can't use it, right? A test run, you could say, well, I could run it without a test run, but normally the test run's only done if it's unsafe to do it without, right? The training is a little trickier. That's why I put some in here. If even one employee knows how to use the system, then I can use it without paying the training. But if nobody knows how to use it and I have to bring in an outside person, then that's necessary, right? So I can't use it without training my employees on the system. And then there may obviously be some other things. The concept in accounting is that the cost of an asset includes any money spent to make an asset ready for use. So that's the key here, ready for use. If it is not possible to use the asset without um, paying this money, then we're going to include it in the cost. All right, so all of these things are included in the asset cost. All right, now an asset's cost, such as we just talked about, is the value of the asset at the beginning of its life. There's also another concept called residual value, which is the value of the asset at the end of its life. Now, you may wonder, how can an asset have value at the end of its life? It makes sense that it has value at the beginning because we haven't used it yet. But at the end of its life, we have used it completely. It's fully used. Well, that's relative, right? So, for example, um, let's say I am driving my car in down to San Jose State, back, of course, when the whole quarantine thing is lifted and we're able to have classes on campus again. Let's say I'm driving my car to San Jose State down the highway. And my car is older, it's not a new car. So let's say while I'm driving down the highway, it decides it's done with life. It doesn't want to live anymore, and it drops out its engine all over the road as I'm going 65 miles an hour down the highway. Okay, now my engine falls onto the road at 65 miles an hour, so it breaks apart, spreads all over the highway. My car, no longer having an engine, comes eventually rolling to a stop as its momentum gives out, and all the traffic behind me comes to a standstill because there are hot pieces of metal all over the road, and I create a massive traffic jam and everyone curses me. Okay, so my car's life is over, right? It doesn't have any more life left. It's got no engine. It can't go anywhere. Okay, but the tow truck driver comes along and he says, hey, I can give you some money for what's left of your car, right? All right, so why does my car have anything left that he'd be willing to give me money for it? Well, the first thing is that cars that are older are still potentially have some value for spare parts, right? Particularly car brands that last a long time. So maybe, for example, like the side view mirrors, or maybe the airbags, or other pieces of the car may have some value as parts. Okay? The other thing is that the car is made of metal. And we all know right now that metal has value. People steal scrap metal from construction sites, right? My catalytic converter has gold and platinum in it. People steal them off the bottom of vehicles. So, I could potentially go looking on the road for that metal piece, right? That might be worth a couple $100s. So I'm not saying my car is worth a lot, right? It's not going to be worth a ton, but there is a little bit of value in what remains, even though the life is over. And that's why we call it residual value, because there is a residue of value in the asset, right? Just a tiny bit left. Sometimes this is also known as salvage value because it's what can we salvage from the remains of the asset. Right, so most physical assets do have a residual value, some tiny scrap value or parts value after it is done. Okay, so the asset's cost is the value at the beginning of the life. The residual value is the value at the end. What happens between the beginning and the end? Well, the asset gets used. And we've already learned that the accounting term for using an asset is depreciation. So the value that's depreciated over an asset's entire life is the difference between its starting value, the cost, and its ending value, the residual value. Okay, so let's formalize that. So the total value that's depreciated over an asset's entire life is the difference between its cost and residual value. Okay, so that's how we set up an asset with its value at the beginning of its life. And of course, what happens in the middle is depreciation. So we're going to spend the rest of the lecture this morning talking about depreciation. Okay, so let's take a look at an example. A company bought a machine for $21,200. Additionally, the company had to pay $1,300 in shipping costs and $500 of installation costs. The machine had a residual value of $2,000 and was expected to last for 5 years or 35,000 machine hours. And the company planned to use the machine as follows. So the 35,000 machine hours, you can see that they're broken out here. Okay, what we are going to do is calculate depreciation expense for every year of the asset's life. But here's the part you don't realize yet. There are multiple ways to do depreciation. It's not just one method. I've already taught you guys one method, so you know how to do that, but there are other ways. Now, the thing is that with things like inventory, right, for costing, GAAP says you have to choose a costing method and it must be one of these four: LIFO, FIFO, average cost, specific identification. With depreciation, GAAP doesn't do that. GAAP simply says you have to depreciate and it has to be a reasonable method. So there are literally hundreds of depreciation methods out there because everyone kind of makes up their own. As long as they can justify it as being reasonable, then they can use it. Now, that being said, there are certain methods that are more popular than others. So I'm going to teach you 3 of the most popular methods. Now, just before I jump right into the depreciation, there is one thing we have to do. We have to figure out what is the cost of this asset. Now, we know that they bought the machine for $21,200, but they also had to pay $1,300 in shipping costs and $500 of installation costs. And we have just learned that those costs are added to the value of the machine. They're added to its cost. So the total cost of that machine is actually going to be $23,000 because it's the purchase price plus the shipping and installation. Okay, now that we have that down, let's look at different methods of depreciation. The first method of depreciation that we're going to talk about is called straight line depreciation. Now, straight line depreciation is the method that I taught you back in chapter 3, right? So you've seen it before. And so we have learned that the straight line depreciation expense per year is the cost over the years of life. That's what we learned back in chapter 2. But I'm altering that slightly to say that in the numerator here, we're going to have the residual value instead of nothing, because we know now that it's the cost minus the residual value. That is the total value to be used over the asset's life. So it's a slightly different formula from what we covered in chapter 2, but still the same idea, right? Instead of just cost, we're now using cost minus residual value. Okay. Now, let's put the numbers in from the question, and we can calculate that our straight line depreciation expense per year is going to be the $23,000 cost minus the $2,000 residual value divided by the 5-year life. And that gives us $4,200 per year. Okay. So let's see what you remember from chapter 2. What is depreciation expense in year 1? Well, it's going to be $4,200. What is depreciation expense in year 3? Well, it's going to be $4,200. What about depreciation expense in year 4? $4,200. Right? This is why we call it straight line depreciation, because if you were to graph the depreciation expense over the years, it would be a nice straight horizontal line, right? It would be the exact same amount every single year. Now, we also learned about accumulated depreciation back when. So we learned that the accumulated depreciation is all of the depreciation on the asset so far. So the accumulated depreciation at the end of year 1 is just year 1, $4,200. At the end of year 2, accumulated depreciation is going to be $8,400. And at the end of year 3, it's going to be $12,600, right? Okay, what is the accumulated depreciation at the end of the 5th year, at the end of the asset's life? Well, mathematically, I could say, okay, it's 4,200 times 5, right? That's the depreciation at the end of the 5th year. But we could also take a shortcut, right? 4,200 times 5 has to be equal to this, 21,000. What did we say back up here? The total value depreciated over an asset's life is its cost minus its residual value. So in this case, right, that's going to be 21,000. Now this is true no matter what kind of asset you're talking about and no matter which depreciation method you use. They all end up in the same place. The total value that's going to be depreciated over the entire life is the cost minus the residual value. In the case of this asset, $21,000. Okay, so that is straight line depreciation. Let's talk about our next method that we're going to learn, which is called the units of production depreciation method. Now, units of production is very similar to straight line. The difference is that we are going to measure the asset's life in something other than years. Right? It's very easy to say an asset will last so many years, but most assets have other ways of measuring the life. For example, if I have a car, I can say that the car is going to last for 15 years, or I will be able to drive it for 200,000 miles. If I have a laser printer, right, I can say that that printer will last for 10 years, or I could say that printer will imprint 5,000 documents. Now, for machinery and equipment, especially in business, it's very common to talk about hours of operation, or what's often called machine hours. So not just the number of hours that you own the asset, but the number of hours that it is plugged in and turned on and working. Right? There are a lot of assets that get used up as they are working. So for example, a cell phone battery, right? That will last a long time if you barely use the phone, right? Not just because the battery lasts, but because even recharging it. A battery can only be recharged so many times before it really starts to die and you have to replace it. So the number of hours of operation of the phone battery is what really matters for how long it's going to last. So the same idea with machine hours for machinery and equipment. How many hours is it turned on and operating? Now, in this particular question, it's pretty clear that the other way of measuring the asset's life is machine hours, right? We think it's going to have 35,000 hours of actual turned on usage. Okay? Now, that should be really obvious in this question, that machine hours are the other way to measure the life. Because not only did I say it here, but of course I gave you a little chart and said, here's how many hours they're going to use it each year. It will always be that obvious. I'm not going to give you a question that says, here's an asset. Hey, what's the other way of measuring the life? And you'll have to think, no. I am always going to be giving you the information you need. So it should be really, really clear. What is the other way of measuring the life other than just straight years? So in this case, machine hours. Now, the formula to calculate unit depreciation is we have to calculate depreciation expense per unit. So instead of per year, it's per unit. Okay. And so the unit, of course, in this case, is the machine hours. So you'll notice that the formula here, the numerator, is exactly the same as straight line. that we have cost minus residual value, just like we did up here, right? But instead of years of life in the denominator, we have the units in the useful life. Okay, so let's put that into our equation. Get the numbers in there. We know that the cost is 23,000, the residual value is 2,000, and we know that it's a 35,000 hour life. So that comes out to 60 cents per hour. Okay, great, 60 cents an hour. The problem is that for the income statement, we need depreciation expense for the entire year, right? Depreciation expense has to be an annual amount. So when I do the 2020 income statement, I am only looking at 2020 depreciation. I need the whole year, not just 1 hour. So if I go look at year one here, how am I going to find the depreciation expense for the whole year? Well, I know it's 60 cents an hour, and I know that I used it for 5,000 hours. So what I can do is I can multiply the 5,000 hours used by the 60 cents per hour. And then that will give me my depreciation expense for the year. And I can do this for every year of the asset's life. All right, so for each year, I can take the number of hours used and then multiply by my rate of 60 cents an hour, and then that will give me my depreciation expense for the year, right? So for each of the years, I can take those hours used and multiply. Now, in the last year here, looks like that one didn't come over. In the last year, we have 9,000 hours and $5,400 of expense. Now, the total hours used, we can see it from up here, right? That's going to total to 35,000 hours. So that's what we've got here. What is the total of all the depreciation expense? All right, well, we already talked about this, right? We said that the total depreciation over the asset's entire life, in other words, the accumulated depreciation at the end, has to be the cost minus residual value. And that's what we're seeing here, right? The total depreciation over the life is the $21,000 cost minus residual value. And again, mathematically, we could just come out and say, look, 60 cents an hour times all 35,000 hours is going to be 21,000, right? So we have the same thing. Even though the individual amounts are different from the straight line method, we're still coming up with the same total, $21,000 at the end of the asset's life. Okay, now we have a third method that we're going to learn, and this is units of production depreciation. Okay, now units of production is a little bit different from other depreciation methods. It's known as an accelerated depreciation method. Okay, so what does accelerated mean? Accelerated means that we use a lot of value of the asset in the beginning of its life and less at the end of its life. Right? So for example, let's say you are in your car and you're sitting at a red light, right? So I'm there, I'm at the red light, I'm in a hurry. So I'm like waiting for this red light to end, and the moment the red light ends, I slam my foot down on the gas pedal and I accelerate. I shoot forward in my car. All right, so I have accelerated up to a big speed, and then I see in the distance there's a cop with a radar gun. I don't want to get a ticket, so I take my foot off the gas pedal, and then I slowly start to decelerate and come down. All right, so that is how accelerated depreciation works. We start out super high. We accelerate to a very, very high depreciation right at the beginning. And then as time goes on, we slowly edge down and have less and less each year. Right? So there are other accelerated depreciation methods, but not units of production. See, here I have the wrong title. The double declining balance method is the most common accelerated method. So double declining balance depreciation is the most common accelerated method. Another example you might have heard of, staying with the cars, you might have heard the expression that if you buy a brand new car and you drive it off the lot, you have lost half of its value. All right, now obviously that's an extreme example, right? It's just a saying. You haven't exactly lost half the value just by driving it off the lot. But the point is that new cars lose value very, very quickly, right? So for example, let's say you wanted to buy that brand new car. So you go into the dealer, you see the brand new 2020 model you want. It's beautiful, it's everything you wanted in a car, but it's a little bit too expensive. You just can't quite afford it. So you're standing there and you're hemming and hawing and trying to figure out how you can afford this car. And the dealer sees you and they say, look, I want to make a deal with you. And I can see this is a little out of your price range. So I tell you what, I have the exact same car in a 2019 model. Somebody leased it for a year and now they're returning their car. So I can let you have the 2019 model. All right, what's the price difference between the brand new unused car and the car that's been used for 1 year? It's going to be significant. It's going to be thousands of dollars, maybe $10,000, right? There's going to be a big difference between the price of the brand new car versus the 1-year-old car. All right, now let's say you weren't looking for a new car, you want an older car, right? You're staying at home, and so you're not going that many places. You just need a beater to drive around town. So you're looking for a car that's 10 years old, and you see one on Craigslist, right? One that you could buy. And you look at it, it looks reasonable, and then you find another car very similar, but it's 11 years old. Okay, what's the price difference between the 10-year-old car and the 11-year-old car? It's going to be minimal, right? Maybe as little as $100, because by the time a car gets to be that old, most of the value is already gone, right? So again, accelerated. We have a lot of value being lost in the beginning of the asset's life, very little value being lost at the end of its life because most of the value has already been taken. Okay, now with declining balance depreciation, we do this a bit differently. So for this method, we need a rate. So the way that we calculate the rate is we take the number 2, that's where the word double comes from in double declining balance. So we have double because we use the number 2 here to calculate the rate. And we divide by the years of useful life. Okay? So for this particular example, our rate is going to be 2 over the 5 years of life, which, you know, for your calculator, make it nice, it's 40%. Okay, so that means what we're going to do is we're going to take 40% of the asset's remaining value every single year. Now, this method, the calculations are a little more complicated, so I'm going to do this in a table, just so you can see all the calculations. So for year 1, right, what we're going to have is we start with the net value of the asset. Now, what is the net value of the asset? Well, let me remind you, this comes from back in chapter 2. We said that the net value was the cost minus the accumulated depreciation. And that equals the net value of the asset. Now, sometimes that net value is called the net book value. Hopefully these terms are a little bit familiar to you. But this is what goes on the balance sheet, right? The asset's cost minus accumulated depreciation, net. So the net value is the total amount that you'll see on the balance sheet after the accumulated depreciation has been subtracted. Okay, so we start with the net value of the asset, $23,000. And we know that because that's the original cost. In year one, accumulated depreciation is 0. Right? So when we start out, we have a $23,000 cost, right? The accumulated depreciation is 0. So the net value is $23,000. All right, so that's what we have in year one. We take that net value and we multiply by our rate of 40% that we calculated here. And that gives us depreciation expense in the first year of $9,200. Now, accumulated depreciation, since it's just the 1 year, is also going to be $9,200. Okay, now let's move on to year two. What is the net value at the start of year two? Is it still $23,000? Well, no, it's not, because by the time we start year two, we now have accumulated depreciation. So for year two, instead of this being 0, right, it's now going to be $9,200. So the net value is now going to be $13,800. All right, so let's put that line into our table. Okay, so in year two, the net value starts out at $13,800, right, as we calculated here. Multiply by 40%, that gives us our depreciation expense of $5,520 and accumulated depreciation of $14,720. I got that by adding the $9,200 and the $5,200. Okay. All right, now for year three, is my net value still $13,800? No, it's not, because now I have a different accumulated depreciation. It has changed to $14,720. So let's put that in here. All right. So now we have a net value of $23,000 minus $14,720, and that is going to be $8,280. So at the beginning of year three, I'm going to have a net value of $8,280. If I multiply that by 40%, I'm going to get depreciation expense of $3,312, and then I get my accumulated depreciation. Now, to get the accumulated depreciation, I add up all 3 years, right? 9,200, 5,520, 3,312. That gets me 18,032. But if I wanted to, mathematically, I could take a shortcut, because this number here, 14,720, that's already the sum of the first 2 years. So these two have already been added together to get 14,720. So I could take last year's accumulated depreciation, and then I could add that to this year's expense. So I could just take the 14,720 and add the 3,312. And that would also get me to 18,032. Okay, let's finish off the last couple of years. So we'll move on to year 4. And I'm not even going to do the side calculation this time. I'm just going to say for year 4, our starting net value is $4,968. How did I get that? It would be the $23,000 cost minus the $18,032 accumulated depreciation. Okay, we'll multiply that by our 40% rate, right? That gives us depreciation expense of $1,987 and then accumulated depreciation of $2019. I can calculate the 2019 by adding together all 4 years of depreciation expense, or to take a shortcut, I can take last year's 18,032, which is the total of the first 3 years, and then add 18,032 plus the 1987 expense from this year to get 20,019. All right, now let's move on to that last year. Year 5 is the final year. My net value is $2,981. That comes from $23,000 minus the $20,019 accumulated depreciation. Okay, so I can multiply this by 40%, but we're in the last year. What did we say about accumulated depreciation in the last year? We said that over the asset's entire life, the total value depreciated, the accumulated depreciation, is the cost minus the residual value. In other words, this number here at the end has to be 21,000 at the end of the asset's life. There is no other option. It has to be 21,000 because the asset's life is over, and this is the cost minus the residual value. If I multiply 2981 by 40%, am I going to get a number that brings me exactly to 21,000? No, I am not. So instead, I am not going to do this multiplication. Instead, I'm going to do a plug. So for my last year, I'm actually going to have $981, which is a plug. So I am basically plugging the depreciation expense, right, to make sure this 981 is exactly what I need to get me to 21,000, which is the total accumulated depreciation I am supposed to have at the end. Okay? So it's only in the last year that we have to do that. Okay, so we can see what we were talking about with accelerated depreciation, right? We start with a lot of depreciation expense, less each year until we get to the end. All right, those are our 3 methods, right? They're not all the methods, obviously. There are many different methods out there, but these are 3 of the methods you're going to see most often in the real world. Okay, now let's talk about our 3 methods. First, we have straight line, right? We calculate depreciation expense per year. What's the advantage of this method? All right, well, basically, it's simple and it's intuitive. This is the one you're hoping to see on the test, right? Because it's the easiest one. We just calculate the one number, use it every single year. We can understand it, right? Very straightforward. For those reasons, this is by far the most popular depreciation method, right? Something like 80 or 85% of companies use straight line for their depreciation, right? So it is the most popular method because it is the simplest method. All right, now what's going on with units of production? That's the one where we calculated the depreciation expense per unit, right? And then we multiply the units used each year by that amount. Okay, so what's the advantage of this method? Well, remember, what is depreciation? What's the definition of depreciation? It represents use. So this method, units of production, is calculating depreciation expense, in other words, the usage expense, based on the actual usage of the asset, right? The hours used. So we're calculating our usage expense based on the actual usage. So that kind of makes sense, right? Units of production is considered to be the most accurate depreciation method because of that approach. All right, so in the textbook or something like this, it's the most accurate method. Here's the problem though, if we want to apply this to the real world. The problem is that in order for this to be accurate, we are depending on this 60 cents an hour. And that 60 cents per hour is dependent upon the 35,000 hours in the total life. Now, realistically, day 1 of the asset's life, is it possible to know exactly how many hours it's going to operate? maybe, but with a lot of assets, not necessarily. Now, I could ask the manufacturer, right? I could say, hey, I just bought this brand new car. How long is it going to last? How many miles can I drive it? And the dealer says, well, these cars go about 200,000 miles. Okay, now 200,000 miles. Does that mean I'm going to drive exactly 200,000 miles and my car is going to stop and die? No, 200,000 miles is an average. It's based on a bunch of data of cars all over the place, and they've averaged it to get their estimate. So maybe I have a lemon and it dies at 80,000 miles, or maybe I have a supercar and it goes for 300,000 miles, or anywhere in between. We don't actually know. It's an average, it's a guess. Now, if there's a wide range of guesses, right, this amount here, in this case, the 35,000 hours, it could be very, very different from that. And if the actual results are very different from that, then the accuracy of this 60 cents just went out the window. So then the accuracy of this whole method just went out the window. So theoretically, units of production is the most accurate depreciation method. Realistically, though, it's only as accurate as your estimate of the units in the life. So if you're fairly certain about this, if you think it's going to be really close to that number, then this is a very accurate method. But if you're not, if there's a big standard deviation, if you think there's a big range of potential numbers, then this is not so good. And then in those cases, people tend to bump back and just do straight line. So that's the issue with units of production. So maybe about 5% of companies use units of production. It's just not always easy to apply in the real world. All right, now the last method here, the double declining balance method. Okay, so why would someone go through all the trouble of doing all these calculations and this extra work every year? It's actually not that much work. You have to remember that each of these lines here is 1 year. So you're doing one line a year. It's not that much extra work. But still, it's more work than the other two methods, and it's definitely a little weird and different. So why would companies use it? Okay, well, there are two reasons. The first reason, and the main reason to use it for accounting purposes, is flexibility. Let's say I buy an asset, but I have no idea how long it's going to last. Maybe it's going to be 5 years, maybe it's 10 years, maybe it'll be 20 years. I don't know. And because I don't know how long that asset's going to last, I have no idea what the residual value is. Okay, what I can do is I can use the double declining balance method. I can put the whole cost here, right? The net value always starts with the total cost. And then I can fudge a rate, right? I can just come up with some number and say, okay, here's my rate. Now, if I don't have to stop, let's say the year 5 never comes and it's just, I don't know what the end year is. So I just keep going. Mathematically, how long can I keep taking 40% and taking 40% and taking 40%? Well, mathematically, I can go forever, right? Because if I take 40%, there's always 60% left over. And so there's always going to be a remaining amount that I can take 40% of every year. Realistically, for accounting, I can go until I get below a penny, but that's going to be a very long time. So what I could do, if I just didn't know how long my asset would last, I can use the cost, fudge up some rate, and then just keep depreciating it. Keep doing this every single year until I finally finish using the asset, and then I can stop. So it's very flexible if you're actually kind of uncertain about what the asset's life is going to be. Give you an example of this. When I was working as an auditor, there was one company where I was auditing, and the controller there was a really, really nice guy. He was on the verge of retirement. He was like 64, and he'd been with the company for a very long time. And he was using a calculator. Right? Now, this calculator had been purchased back when he got the controller job back in the 1970s. Now, in the 1970s, that's before the microchip. So a calculator in the 1970s was a very simplistic device. It had your basic add, subtract, multiply, divide. That was it, right? But it was the cutting edge of technology because, it was computing things, right? It was calculating your numbers. And even though it didn't have any of the fancy things a calculator could get today, right? I could get a calculator for $1 that would do a heck of a lot more than the calculator from the 1970s. It was very rugged, right? It was a really big, like a box on his desk, and he would use it to add up numbers. And I went by his office and I saw him using this calculator from the 1970s. He was still using it, even though now it was like 30 years later. All right, so he purchases this calculator in the 70s. He's still using it 30 years later. Now, on this particular audit, I was in charge of the long-term assets section, which meant that I had to calculate depreciation for all the assets. So I turned to all the assets and yep, it's double declining balance depreciation. So for each asset, there's a page like this, and I have to fill in the next line, right, on each one. So I'm doing that, and I get to a page, and sure enough, it's the calculator. The calculator that was purchased in the 1970s. Now, that calculator in the 70s, remember I said cutting edge of technology, it cost $3,000. So on this big page, I had $3,000 at the top here and some rate, whatever it was. And there were 29 lines like this. And I was clearly supposed to fill in line 30, right? And keep going. He had been depreciating this $3,000 calculator for 29 years. Of course, by the time it got to me in year 30, it was like $30 left here. This was a very small amount. So I said, all right, I could do one more line, $30 times whatever percent. But I'm like, $30, that's immaterial, right? That's a tiny amount. It's not going to make a difference to the financial statements. And we should not really be doing all this work and calculating depreciation expense on this calculator every single year. It's not worth it. So I did this. Instead of doing the regular depreciation, I did a plug and I brought the accumulated depreciation up to the full $3,000. And I said, yep, no more depreciation. It's done. And this controller was so mad at me because he was very, very by the book. And he said, hey, I'm still using this calculator. We need to keep depreciating it. It was like a personal thing for him. Fortunately, the partner on the audit agreed with me, said it's not worth it. Let's just depreciate the whole thing down to zero value. But wow, this controller was not happy with what I did. He wanted to keep going for more years. So just an example, you can actually keep depreciating pretty much forever under this method. So if you're flexible and you don't really know what your life is supposed to be, you fudge up some rate and just keep going. So most of the companies that use double declining balance for accounting purposes, this is why they're using it. They're using it because they want that flexibility. They don't really know how long their assets are going to last. Now, there is another reason for declining balance, and that has to do with this whole accelerated concept. Let's take a look at the depreciation expense. Under straight line, it's $4,200 a year. $4,200, $4,200, $4,200 every year. Under units, it goes up and down, right? But it's still roughly the same kind of amount every year. It goes as low as 3,000, as high as 5,400, but it's just, a smaller amount. Now, what about here with double declining balance? In the first year, $9,200. That's more than twice as much what we're doing with straight line. And the next year, still $5,500, still a lot. And then it starts getting smaller and smaller. But we've had very high depreciation expense in the first couple of years. Okay, what is the one time that we want high expenses? All right, we talked about this last lecture. We want high expenses when we want net income to be low. And the one time we want net income to be low is when we're filling out the tax return. Okay? So for taxes, we want the expenses to be high. Now, with the inventory costing that we talked about last time, FIFO and LIFO and all that, the IRS says whichever method you choose for accounting is also the method you're going to use on your tax return. But with depreciation, it's different. With depreciation, the IRS says we have our own method of depreciation. It's called MACRS, M-A-C-R-S. I'm not going to test you on that. MACRS stands for Modified Accelerated Cost Recovery System. But essentially, the system that the IRS uses is declining balance, right? They make a couple little shifts with it, but essentially it's declining balance. This is what you do on your tax return. And you don't have a choice. You have to do that on your tax return because that's what the IRS says you have to do. So no matter what you do for accounting, you have to use declining balance for taxes. Now, why does the IRS use declining balance? Because back when the IRS was trying to decide which depreciation method to apply on the tax return, the companies lobbied for this method. Right? Companies said, hey, if we get declining balance, we're going to get a lot of expense in the first few years of the asset's life. And that means lower net income and lower taxes. Yes, we have less depreciation later on, but what we've effectively done is we've delayed paying our taxes for a few years until we get down to these low amounts. And if you talk to any tax expert, they'll tell you delaying paying your taxes is almost as good as not paying them at all. So using declining balance is going to delay your taxes by having high expenses in the beginning. So the corporations lobbied for this method. And, they sent letters to their congressmen and they said, here's what we want you to vote on. And it worked. That was the method that was eventually adopted. So the IRS uses declining balance. All right, so the answer is you can choose any method that you want for accounting. But for taxes, you have to use declining balance. Okay, so declining balance is accelerated, so it has a lot of depreciation expense in the early years, gives the lowest net income, right? So therefore, it's going to be advantageous for taxes. The method is also useful if you have uncertainty regarding the asset's life or residual value. So just want to remind you here that unlike inventory costing, you cannot choose the depreciation method you want to use for taxes. You have to use the IRS depreciation methods. So you have to use declining balance there. Okay, so to summarize, straight line, simplest, easiest, most popular for accounting. Okay? Units of production is theoretically the most accurate, just difficult to apply that in the real world. Declining balance is required for income taxes, but people also use it for accounting if you want to be flexible with the asset's life or residual value. Okay, so what I'd like to do now is just go through one more example and show again how we do this depreciation. All right, so example 2. Rancor Sales Inc. bought a delivery truck for $40,000 on January 1st. The truck was expected to remain in service for 4 years or 130,000 miles, after which time it would have a residual value of $1,000. Rancor expected to drive 40,000 miles in the first year, 50,000 miles in the second year, 25,000 miles in the third year, and 15,000 miles in the fourth year. Okay, so we're going to use all three methods, and we're going to calculate depreciation expense on the truck for each year. So let's start with the simple, easy method, the one that's the most popular for accounting, straight line. So under straight line, the straight line depreciation expense is going to be cost minus the residual value over the years of life. Okay. All right, so let's put in those numbers here in our equation. We can see that the cost of the asset is going to be $40,000, right? And the residual value is going to be $1,000, and it's going to remain in service for 4 years. So we put those numbers in here and we come out with $97.50 per year. All right, so year 1, $97.50, year 2, $97.50, year 3, $97.50, year 4, $97.50. So we've calculated the depreciation expense for every year. Okay, so now let's look at the unit method. So for units of production, remember we have to figure out the other way of measuring the asset's life. And I think it's pretty clear here in this question that we're talking about miles driven, right? Because it gives us all this information about the miles the truck is driving. So we're going to calculate depreciation expense per unit, which in this case would be per mile. So we have cost minus residual value over those units or miles in the useful life. So putting in our numbers here, the cost is $40,000, the residual value is $1,000, and we were told that it's going to have a service of 130,000 miles. So that's going to be 30 cents a mile for us. Okay, now we get to calculate our depreciation expense for each year. So in the first year, we're going to take the fact that they drove 40,000 miles and multiply that by 30 cents a mile. And then in the second year, right, they drove 50,000 miles at 30 cents a mile. And in the third year, they're driving 25,000 miles, 30 cents a mile. And in the fourth year, they're driving 15,000 miles at 30 cents a mile. Okay, now, if we add up all of these miles here for each year, that's our total of 130,000 miles, right? We've driven the whole thing. Now, what is the total if we add up all the depreciation expense from each year, the 12, the 15, the 7,500, and the 4,500? Well, that's going to total $39,000. How did I get 39,000? I mean, I could add them all up, but it's the cost minus the residual value, right? Remember, at the end of the asset's life, the total depreciation expense is going to be 39,000. Was it 39,000 for straight line? Well, if we multiply 97.50 by 4, right, all 4 years, we're going to get 39,000, right? 40 minus 1. So yes, it's 39,000 for both. Okay, now we move on to double declining balance. And if you remember, double declining balance uses a rate. So our rate is the number 2 over the years of useful life. So for this particular question, right, the rate is going to be 2 over 4 years of life, or 50%. Okay, so I'm not going to do the table this time because it's only 4 years. Let's just see, if you have a shorter question, it's probably not worth doing the table. Let's just calculate it directly without the table. So in year 1, what we're going to do is take the net value and multiply by our rate of 50%, or 1/2. Right? Now, what is the net value to start? The net value to start is always the cost. Because remember, net value is cost minus accumulated depreciation. And in year 1, there is no accumulated depreciation yet. So we always start with the full cost. So for year 1, what we have is the full cost of $40,000 multiplied by our rate of 50%, or 1/2, to give us depreciation expense of $20,000. Okay, now what about year 2? In year 2, what is my net value going to be? Well, my net value is going to be the $40,000 cost minus the $20,000 I've depreciated already, right? So I'm going to have a net value of 40,000 minus 20,000, or 20,000, right? So the half I didn't depreciate, that's what's left. We're going to multiply that again by our rate of 50%, or 1/2, to give $10,000. All right, now, so far we have depreciation of $20,000 and we have depreciation of $10,000. So what we've got is accumulated depreciation of $30,000, which is the 20 plus the 10. Okay, now in year 3, my net value is going to be the $40,000 cost minus the $30,000 of depreciation already. So for year 3, we're going to have 40,000 minus 30,000, right? That's the depreciation so far, times our rate of 1/2. That gives us $5,000 of depreciation expense, right? You can see the declining part, right? Starts very high and then gets lower in a hurry. Okay, at the end of year 3, our accumulated depreciation is going to be 20 plus 10 plus 5. So it's going to be 35,000. All right, now that brings us to year 4. If year 4 were not the last year, right? If I had more years to go, then what I would just do in year 4 is I'd take $40,000 cost minus $35,000 of accumulated depreciation so far, and then multiply that by 1/2. But that's not going to happen because year 4 is the last year. And we know that in that last year, we need the total depreciation expense, the total accumulated depreciation, we need that to be $39,000. Okay, so if it's going to be $39,000, what I've got to do here is I've got to figure out what I need to get to $39,000. Well, I've got $35,000 so far with these 3 numbers, right? So I have $35,000. I'm going to need $4,000 to get myself to $39,000. So in year 4, instead of multiplying by my rate, I'm just going to have a plug. The difference between the $39,000 total I need and the $35,000 I've already got, and that will give me $4,000. So that's how I get to my total accumulated depreciation at the end of $39,000. Okay. So those are the 3 methods, and you can imagine you're going to be practicing those in homework. So let's move on to part B of the question. Which method best tracks the actual wear and tear on the truck? All right, well, that is going to be the unit method, right? The units of production is the most accurate method. So we're tracking the actual wear and tear because we're calculating depreciation expense based on the actual miles driven. All right, and then let's look at part C of the question. What will be the truck's accumulated depreciation at the end of the 4th year? And is this amount different for each method? All right, at the end of the 4th year, it's going to be $39,000, no matter what, right? It's going to be $39,000 regardless of the method used, right? So it's going to be $39,000 because this is the cost minus the residual value. And it will be the same for all methods. Okay, so I think we've had enough depreciation for today. So I'm going to give you the homework that's due on Tuesday. So from last lecture, you had from chapter 5, questions 2, 3, and 5. And now from this lecture, chapter 6, questions 1, 2, and 3. So that's all due next week. And then I will be back next lecture. We're going to talk more about depreciation and also a couple of other things related to some liabilities. Okay? So that's coming up next time. Until then, stay healthy.